How you guys doing? Welcome back. Today is lesson 43, red days. I think this is a very important lesson. It's going to be tied to mental analysis with a strong emphasis on technical analysis, even fundamental. But again, this is a very big deal that not many folks talk about. Not a lot of folks dive into what do you do on red days, how do you judge if it's a red day, and how do you act accordingly. The biggest issue is that a lot of beginners see red and they panic. And as we've discussed in the past and we've talked about a lot, predefined risk and predefined reward get rid of emotion. If you truly accept the risk, there's not going to be an emotional situation. Yes, you may hit a bunch of stop losses, that sucks. But when you stick to your plan and have good planning and you just get better at this, then you can start saying, hey, probably should wait to enter here, wait to enter there. We'll discuss that today as well. We'll discuss all these kinds of great things with red days and how to avoid panicking and what you should be doing on red days, in my opinion. So first and mainly, I want to look at the S&P 500. Now, again, this has been a 11-year bull market. May not be happening when you check out this video in the future, but we're going to look at all the structure that it has, how to play off it, what I'm looking at for different zones, and even if it does go sideways like the Russell 2000 is, you can still find very easy value on the macro side to buy on the micro side. We talked about this before, but I want to really emphasize it for red days. I also want to briefly discuss buying the dip. Where's the dip? What does that even mean? Is the dip a percent, 2, 3? How much is the dip, and how do you even know if it's actually happening? We'll discuss that today and show that technically as well. Lastly, I want to talk about indicators when it comes to technical analysis today and how I use certain indicators on macro scales. Yes, we've covered this before, but again, I want to really dive into, hey, if it's a red day, but you're, this high in the S&P, currently, what would you do? Hey, if it's a red day and you're here in the S&P, or hey, here in the Russell 2000, what do you do based on different situations and how hype you are based on where red days are, dips are, and finding patterns and support? That's huge. And then lastly, I want to have a quick conversation with you. Like I'm your mom or your dad and you're in high school, like, no, Billy, you shouldn't be doing this. I want to have a quick conversation about what you can do on red days. Yes, you can buy, which is never a terrible idea if it's a good value. But what can you do besides buying stocks to be active in the market? There's going to be some days, it's hard for you to hear, the best position is none. You can just hold what you have or do nothing. And if that's the case, some of y'all got them trigger fingers and itchy devil fingers, you want to get going, want to do something. There are things you can do, and we'll discuss that as well today. With that being said, lesson 43, red days, what do we do? Let's check it out together. So when it comes to red days, my first idea, my first thought, my first notion is, where on the S&P are we? Now again, if you like to trade blue chips, maybe it's the Dow 30. If you like to trade technology, maybe it's QQQ. For me, it's always in the S&Ps where I start at. That's the heaviest, that's the best cross section to me. I'm home there, I like it. You can use anything you want. You want to do only mini caps and micro caps and small caps, Russell 2000 is fine too. But for me, I always think, where in the S&P are we when it comes in relation to value? The reason is, a lot of folks talk about buying the dip, but if you're at the top of a structure or at top of the price action, the dip is 1%. You may have 5% more to come down to be truly at value where that dip's actually going to be headed to. So I think it's very critical to start your day, start your morning, continue your afternoons on red days to check the S&P 500. With that being said, I'm going to show you what I see and how I chart it out to plan my actions accordingly. Let's check it out. So this is the 360-day 4-hour chart. Yes, you can use the 180-day. Yes, the 10-year. Yes, you can even go to the 1-year, 1 day. That's the most popular for these kinds of things. That all works fine. I'm going for the 360-day 4-hour. It's the same thing as the 1-year, 1 day, just more candles, which I like for the action itself. We can see clearly, technically there's some great levels here. Now there's different ways of doing this. We've discussed this before, but just to reiterate, support, resistance, trend, pattern. Those are the 4 main things. Volume profile works very well here as well, but you want to find levels of where price has gone back and forth for channels, 100% success. That's an early lesson, but again, just to reiterate, that's what we're looking for. So I think clearly with this pattern, and this is not historically how it's been. You can go to the 10-year, and you can see we have plenty of times, years in fact, that we have just big old channels. We have really good channel ups, we have really good supports up, whatever it is. You can see clearly we've had plenty of action that's very, very telling of how this market works. And I think this is a very simple idea here. So let's go to the bottom, come all the way over, and we can see, oh, we're very close to having a Nice little support line there. We can make this a nice little channel, just like this, and we can see, boom. We've had a really nice channel up for almost a year, if not longer. Now you can play off of this perfectly if you wanted to. The issue here is that if you were to play off of this channel up, you would have bought 3 times this year. And again, going backwards in time is much easier than trading in the moment. So it's not the best thing to do here, but it's very valid. And so what you could also do, as my cat starts acting up, is that we can come over here, take our trend line, go in the middle, just like our regression line we talked about in our last few lessons, and find plenty more hits here. What I'm getting at is that there's plenty of action going on that you can buy off of. Let's make a nice structure here. That's our price structure currently. Why is this important? You can see towards the top, towards the middle, towards the bottom. Our goals should be different. Take a second to think about that. If we're towards the top of this channel up or towards resistances, which we are currently, our goals, our actions, our planning, our implementation and execution will be different if we were 3% lower or 6% lower. So up here, what's what I want to do? Here's my list of what I want to do. While we're this far up on the S&P 500, again, it could be a hot sideways channel here towards the top. For now, it's a channel up, a wedge up, whatever it is. My first thing is I'm getting defensive. Why is that? The risk versus reward up here is minimal compared to our usual stocks we look at together and talk about. We're buying low, selling high. We are currently high. Can we buy high and sell higher? Absolutely. But is that the best case scenario here? Yeah. What's the worst case? Way worse than that. Hey, maybe we make a few percent off a move up here. Not great. So this high up on the S&P, I'm getting defensive. Again, let me just show you real quick just so you can see real quick. You can see this high up on this channel up that we have going on. I'm getting very defensive up here. This is not great value. Look at the Russell 2000, right? Right here is fine. This is a good value. But if we're over here, this is the price action. Am I buying to go long up here, given previous price action? Up here? Absolutely not. So the S&P like this, I'm currently being defensive. What's that mean? I'm looking to take profit. Does that mean I'm being hasty and selling everything? No, there's definitely melt up possibilities here. There's more room to run up, technically speaking. You could have more fundamentals push us higher. I'm not getting excited and selling everything, but my first goal here, besides getting defensive and, foot off the pedal here, I am in fact getting ready to take my profit-taking strategies. We discussed that before, but again, value, you can buy when it hits a certain price target, you just get out. EMA line cross under, also fine. When your EMA crosses under the S&P, works fine too. I'll show you that. And then thirdly, scaling out, right? At this point, you may want to start thinking about taking some profits. It makes sense. Thirdly, I'm planning some form of bearish hedging strategy. Now, if you have long-term holds, years and years ago, you've had long-term holds, you're adding some long-term holds here, you don't want to sell, right? You know in 35 years, you want to hold on to Apple. You're not going to sell Apple now to buy back in. It makes no sense. But if you have cash laying around, is there a bear ETF that's inverse the S&P that's not value you can buy into, make some quick money in a short? Are there stocks that are so overbought they're ready to be shorted down? I am preparing some form of hedging strategy. Do I have to? No, you don't have to. You can just be cash and have a good time. But I am preparing shorts in case the market starts to come down and I want to be active. I just reverse from buying at value to now selling at overbought. So again, I think it's important for you to understand this high up, shorting becomes an option. I don't like to short for more than 2 or 3 days at a time, but again, it should be an option in your cards. You're ready to play in this market. It makes sense to me. And lastly is the possibility of a melt up. Now, melt ups go up 1%, down 0.8, up 1%, down 0.8. They just take their time going back and forth. When we're in the top 1/3 quadrant of the S&P in this kind of strategy here, I use 1/3. When we're this high up, melt ups are where it's happening. They don't really happen that low or that middle area. On the way up and at the top there, melt ups are bound to happen. So I think this is a good spot to implement some kind of melt up strategy, whether it's smaller position sizing, having smaller price targets, because again, we're not going to have big moves. This high up, we're going to have stairs up, nice stairs up, and then an elevator down. So I think scaling in slowly, having small price targets makes a lot of sense here. So this high up, that's what I'm doing. Let me show you technically what I want to show you real quick. This is great. So this is SPY, and again, it's a very nice channel up here, right? Let's just take this and measure it out. So from where it is now, this whole entire channel is what, 7.5% or so? 6.5%, 6.7. That's fine. So let's go ahead and make a block that's 2.3%. So we have this one right here, that's 2.3. Scoot over, 2.3. Great. So anytime we're in SPY in this formation,